Let's bring on board Nirav Sheth, Institutional Equities Head at SBICap Securities. Nirav, hi morning. Just mapping the moves on IT and what a phenomenal move you're seeing across the sector. Do you think come tomorrow Infosys will be able to deliver? Because it seems like the market is getting into the earnings with high hopes from IT.
So this is a seasonally weak quarter for them, and our expectations are that they'll do about 2% constant currency growth and maybe 3% in terms of the actual dollar returns. I don't think that that changes the trend of the way of we want to look at software.
So what's leading to the optimism then?
The optimism is largely driven by the fact that it's become more of a currency play rather than the actual earnings growth, right? So it's an insurance play because we are worried about what happens to the crude oil and therefore the rupee depreciation and therefore the outlook on the earnings. Just look at the last 4 years. They have consistently gone down from about 18% to 12% to now about 9% growth rate, right? That is, and you are adequately priced for that. You're still trading at about 14 or 15 times. I think that they're in a mature phase. I think they've lost the best times of trying to acquire domain expertise and get into a high valued play. I think they've missed that opportunity. So it is a very, very neutral view on the sector.
How much of the current selling in OMCs is a reason to buy these stocks? Because there is no confirmation whether OMCs have been instructed by government to absorb the impact of crude. Also, we've seen this kind of a phenomenon which always happens before state elections and then things normalize. So do you think the market reaction or the price disruption in OMC, not yesterday but from the recent high, is an opportunity to buy them?
Indeed, I think if you actually want to play OMCs, you are better off buying when things are beaten down and out, rather than trying to assume a secular growth rate going forward. Now, just look at it on a 1-2 year perspective. Even if you assume that OMCs are behind the curve in terms of taking a price increase because of increasing crude oil price, what is the final impact on the book value over the next 1 or 2 years? It is not minimal. Do you have a history to look forward in terms of how the OMCs have behaved? Yes. Gujarat election, they stopped taking the price increase about a month back. After the election, they took a very, very rapid price increases. So if you look at the spreads right now, marketing margins, they are close to about 3 rupees. The long-term average is 2 rupees 40 paisa. So I think that the mandate is very clear that you get into a free pricing scenario, but you will have to live with this kind of dislocations every time you are nearing the elections. Things are getting compounded, the problems are getting compounded by the fact that you've got uncertainty around the evolution of the oil price.
So will you buy after yesterday and today's price fall, or would you wait for a further decline?
I don't think that. I'm not a great believer that you can,
time it to perfection.
Time it to perfection, exactly. It doesn't work that way.
No, so aside of oil marketing companies, what else do you think will come under the lens on account of the election overhang? I would imagine construction, real estate, any of the investment-led themes will also be drawn into the same ambit.
Yeah, so I think that if you look at construction, if you look at the EPC companies are doing fine, that is independent of what's going to happen with the elections. But I think if you take next 1 year perspective, then I think one thing that you may want to look at is utilities. Right, so if you look at the spot prices of on the IEX exchange, they have moved up to almost about 4 rupees 20 paisa. Even I think there's too much of pessimism around utilities, right? So your consumption is growing at about 6 or 7%. That means that you are consuming about an additional about 12,000 megawatts of electricity every year. You are adding about 4,000 megawatts. So you are consuming at the rate of incremental 6,000-7,000 megawatts every year. Now go out 2 years. And suddenly you will figure out that your demand supply completely goes out of the whack. Any entrepreneur sitting right now, we want to set up a power plant, we'll have enough reasons to get bullish in next 18 months. So I think that utility is one which can straight away link to how the elections are going to play out.
Okay. I'm asking this question perhaps to everyone on a daily basis, that what explains these P multiples of a Titan, Jubilant, some of these stocks which are trading at P multiples of not 30, 40, but even 70 times now. And yet, despite expensive P multiples, those are the stocks which are going up on a daily basis. So one side we are saying everyone is concerned about valuations, and on the other side, stock where valuations are skyrocketed, those are the ones which are going higher.
Right. So it's a very interesting question, and there are no easy answers, right? You can actually add DMART to that, right? So you've gone from a 50p to 150p and stuff like that. A large part of the reason, I think that if you again there's no way to answer but the fact that you look at what can happen in the next 5 or 10 years. A big part of the value that comes from a lot of these companies is the competitive mode. You cannot recreate a Titan right now, right? If you look at the market share, it is abysmal in terms of what is the revenue opportunity over the next 5 or 10 years. And therefore, technically, fundamentally, if you argue, I can make a counter argument and say that if the company's earnings can compound at even a 12 or 15%, virtually there is no price, right? So if my required rate of return is 11%, if the earnings are compounding at 15%, take your guess in terms of what the value of the stock is going to be.
No, but the P multiples of a DMart, if it is 150, I don't know what is the P multiple, but if I go by your number, or if the P multiple of Jubilant is 70 times according to our numbers, entry price also matters, right?
Of course it
Future
matters.
return is also an indication of entry price, because when you're buying a equity or you're buying a bond, you're actually buying future growth, and if you are buying in next 4 years of future growth, then where will be the returns?
Right. So I completely agree. So if you ask me what is happening for a lot of these stocks, they are priced right now to give you just about 11 or 12% returns. There's no doubt about it. But the point to ask over here is that if you believe that the company can generate, Titan generates close to about 30% ROE. If you believe that it generates 30% ROE for the next 5 or 10 years, let me tell you, end up making money even by buying it over here.
Okay, so give me a list of stock where you think returns will be more than 20% in next 3 years. I mean, I'm talking about 15 to 20% CAGR returns in next 2-3 years.
I think that the corporate banks will double in the next 2 years.
Okay.
So you're looking at returns which are far higher than that. I think it surprises me if a Bandhan Bank trades at a market cap of 60,000 crores and you get you know, Axis Bank at 1,25,000 crores. I think that once you see earnings normalizing, that's a pocket they are extremely bullish on, and I think that is what is going to drive the market, because banks are going to power close to about 50% of the earnings growth going forward.
What about NBFCs? They too in the same vein, considering they've corrected a little bit from the top, now with RBI upping the FPI limits as well in G6 and bonds. That's sort of aiding the recovery for them too.
Absolutely, but I think a lot of this is common narrative in the market that, you know, you got a counter-cyclical move in bond yields and therefore you get out of NBFCs. Go back and look from 2011 to 2013 period. You had an increase in bond yields. Look at the operational performance in terms of at what rate did the book value compound. The compounding was close to about 20% and the stock price outperformed, right? So these are structural stories. I think what the market sometimes fails to understand is the fact that the business model of the companies evolve. So if I look at, let's say for example, let's talk of housing finance companies, right? You got one segment of the market which is, let's say, pure, simple, plain vanilla mortgage. Very competitive. Spreads are about 2%, ROEs are, our estimates, ROEs are not more than 12%. But then you get into LAP, you get into self-employed category, you get into builder financing, and these are great opportunities because there's a regulatory arbitrage in terms of trying to fund these opportunities going forward. We just initiated on housing finance companies yesterday, and we are bullish on most of the companies in the sector. Very bullish.
So you believe, irrespective of the valuations, this is a segment which is a buy?
Valuation there, at least you can make a case that they are reasonable. We are talking about companies are trading in the region of 2.7 times to 3.4 times. So they are not out of the whack. India Bull Housing does an ROE of 24%. SDFC Bank does an ROE of 16%, right? Okay. So we are talking about some really great evolved business models.
Okay. I see SpiceJet as SBI Securities top pick.
We are bullish. We are bullish on aviation. First of all,
no, but why SpiceJet within aviation?
Okay.
You know, it's really a story between SpiceJet versus Indigo.
Okay, so let me give you some metric. SpiceJet has got a market share of about 13%, right? And it's got a market of 8,500 odd crores. You got Indigo, which is a market leader, which has got a market share of 37%. So roughly 3 times that of SpiceJet. Yeah. The market cap is 50,000 crores. Now look at the per unit profitability on a per seat basis. SpiceJet is almost as good as Indigo.
Actually, yeah, somebody mentioned this about a while back as well. Yeah.
Absolutely. But the fleet size is also half.
Yeah, but I think this is not necessarily a sector where you got scale economies. This is a complete misnomer in the industry. It's a modular structure, like a bank. SDFC used to make 18% ROE when it had 50 branches. It is making 18% ROE when it's got 4,000 branches. Likewise for Indigo, just look at it. Indigo essentially was profitable all the time when it had 10 planes to now about 140 planes. So we see almost a similar evolution for SpiceJet.
Okay, Nirav, we could have gone on talking, but have to let you go. Thanks so much for taking the time out and speaking with us today.